Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 1, and this is Section F. This is a remembering and understanding topic. Identify the appropriate financial statement ratio or performance metric to perform a specified type of analysis. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions. If you don't know much about our strategies, that is one of our main ideas, is why spend time watching lectures or going through the textbook when the most important thing that you're going to be doing on test day is answering questions and doing sims. So you need to know how to do that. So that's what our main strategy is. If you want to learn more about our other strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We will teach you the key ingredients to passing the CPA exam so that you don't waste months or even years of your time. Also, just letting you know, we will only be going over 5 questions in today's video, and normally there is a 10-question version of the video for members on the Pro Member Forum. However, for today's video, this is another one of those where we're only going to be doing 5 questions, and that's the same for the YouTube version and the member version, because this is kind of an intro topic that's pretty small, because the following videos where we're going to be talking about calculating each of these different ratios, I think will broaden your understanding a lot more. So we're just going to give a brief overview in this video. But like I said, normally there is a 10-question version of each video that members have access to get more practice and more understanding. So if you like this and you like our other videos, make sure you go to SuperfastCPA.com, like I was saying, and checking out our free 1-hour webinar and seeing if you want to become a pro member, because again, you get more access and more resources by doing that. With all that said, let's dive straight into the questions. All right, here we are at question 1. Which profitability ratio would be most appropriate to assess how effectively a company is managing its production and sales costs? Okay, so if you don't really know anything about the ratios, and we're going to be talking about a few different ratios in this video, if you don't know anything about them, that's okay. The main idea behind these questions is a little bit less about picking the correct ratio, which of course is important, but more about understanding the different types of ratios that there are, because we're going to dive into each different type of ratio and expand on all the different ratios that fall into those categories in the following videos. So again, we're learning about a few different kinds of ratios, but mainly we're focusing on the different categories of ratios in this video. So if you don't know which of these profitability ratios, and if you don't even know what a profitability ratio is, that's okay. We're going to dive straight into the answer to get an understanding for this one. All right, here we are at the answer. The answer is C. Gross profit margin would be the best one in this case. It's the most appropriate one to assess how effectively the company is managing its production and sales costs. Now again, we're going to learn a little bit about the gross profit margin, but the thing that we mainly want to focus on is what are profitability ratios so that we can understand those going into the next videos. So with that, let's go ahead and read the explanation. The gross profit margin measures the percentage of revenue that exceeds the cost of goods sold. It indicates how well a company controls its production and sales costs, showing how efficiently it turns revenue into profit after covering the direct costs of producing goods or services. This makes it the most appropriate ratio for assessing how effectively a company manages its production and sales costs. Profitability ratios are used to evaluate a company's ability to generate profit relative to various financial metrics like revenue, assets, and equity. They provide insights into the efficiency and overall financial performance of a company. Key profitability ratios include gross profit margin, net profit margin, or sometimes that's just called profit margin, and that's the overall profitability after all expenses. Then there's return on sales, that's the operating profit margin. Then there's return on assets, that's ROA, I'm sure you've heard that. There's DuPont return on assets, that would be breaking down the ROA into profit margin and asset turnover. And asset turnover is not a profitability ratio necessarily. We're going to talk about that a little bit later. Return on equity is ROE, and then there's the operating cash flow ratio. Together, these ratios offer a well-rounded view of a company's financial health and operational effectiveness. Essentially, profitability ratios are all about knowing how well the company is doing when it comes to profits. How are they able to generate profits relative to their assets, their liabilities, and things like that. Think about like profit margin and things like that, similar to that. That's the idea of profitability ratios. Now again, in this video, we're not going to dive super deep into all of the different kinds of profitability ratios, because I believe in the following videos where we're going to talk about each different category of ratio and do calculations, that's where you're going to get an even deeper understanding of all of these different ratios so that you would know when to use them in different times for different analysis. But I want you to understand the categories so that you can kind of have a general idea of what am I trying to do here? this would probably be a profitability ratio. Okay, so what profitability ratio would I use? And like, it kind of gives you a good starting point. So let's go ahead and go to the next question to learn about a different category of ratio. All right, here we are at question 2. If an analyst wants to understand a company's ability to handle a sudden need for cash without selling inventory, which ratio would they use? Now again, this might be calling on some of your college knowledge or even your normal work knowledge. Which one of these would they want to focus on if they don't want to focus on selling inventory? If you don't know, that's okay. Again, we're not necessarily testing you on these specific ratios necessarily. The idea is to kind of get an idea of what kind of ratios fall into the next category, which we're going to talk about when we go to the answer. If you have an idea, pause the video. If not, let's go ahead and look at the answer now. All right, the answer is A, the quick ratio. So let's give a quick overview of the quick ratio, and then we will talk about what kind of a ratio the quick ratio is, which is a liquidity ratio. But first, let's start with the quick ratio. This is also known as the acid test ratio, if you've seen that before. It measures a company's ability to meet its short-term obligations using only its most liquid assets. So what is that? These assets include cash, marketable securities, and accounts receivable. It does not include inventory. This ratio provides a stringent view of liquidity by assessing if the company can cover its immediate liabilities without relying on selling inventory, which might take longer to convert to cash. So that's the quick ratio, seeing how quickly they can be liquid, how quickly they can get money and use it to cover things. Now, I mentioned liquid. This is a liquidity ratio. Let's talk about liquidity ratios. These, in general, assess a company's capacity to meet its short-term obligations and maintain financial stability. Key liquidity ratios include the current ratio. I'm sure you've heard that. This is something that considers all current assets, including inventory. Then there's the quick ratio we just talked about. It excludes inventory for the immediate assessment. And then there's other ratios that I'm sure, again, you've heard about, like accounts receivable turnover, days sales in accounts receivable, inventory turnover, days in inventory, accounts payable turnover, and days of payables outstanding. These ratios collectively offer insights into how effectively a company manages its working capital and short-term financial health. So liquidity ratios, it's kind of in the name, these are all about assessing if they can quickly cover whatever they need to do, and also showing how quickly things are turning over. You know, how quickly are our accounts payable turning over? How quickly are our receivables turning over? Are we getting money quickly, or is it taking a long time? Different things like that. It's all about the short-term ability to get money, pay money, and things like that. So that's liquidity ratios. They're different than profitability ratios. Profitability ratios are all about how well are we making money, how well are we doing that. And liquidity ratios are all about how quickly are we getting money, how quickly are we paying money, and again, it's the short-term stuff. Now let's go to the next question to learn about another type of ratio category. All right, here we are at question 3. Which ratio would be most appropriate for assessing a company's long-term financial stability and its ability to meet long-term obligations? Okay, so this is different than what we just saw with liquidity. This is talking about long-term. Which one of these, again, would they use for long-term financial stability, for long-term obligations? Would it be the interest coverage ratio? It didn't really mention anything about interest. Would it be the current ratio? No, we just talked about that. That's a liquidity ratio. Return on assets? I think we mentioned that that is actually a profitability ratio. So that leaves the debt to equity ratio. And you'll see this as you go through questions frequently. You'll be able to pick out the wrong answers or pick out some of the right answer just based off of what you previously covered in the other questions, and your knowledge starts building off of itself. Let's go ahead and look at the answer because, again, I think we figured out it's the debt to equity ratio. All right, we were right. The answer is D, the debt to equity ratio. Let's read about that ratio specifically, but then again, we're going to talk about the category that this is in, which is a solvency ratio. The debt to equity ratio measures a company's long-term financial stability by comparing its total debt to its shareholders' equity. This ratio indicates the proportion of financing that comes from creditors versus investors, providing insights into how leveraged a company is and its ability to meet long-term obligations. A lower debt to equity ratio generally suggests a more financially stable company with lower financial risk. Basically, they have less debt than they have equity comparatively. That's basically what it's talking about there. Now, debt to equity ratio is not a liquidity ratio, it's not a profitability ratio, it is a solvency ratio. And again, we're talking about all the different categories of ratios so that we can go into the next videos with a basic idea, a basic understanding of what we're looking for with different kinds of analyses. So solvency ratios in general assess a company's capacity to meet its long-term obligations and maintain financial stability over an extended period. They offer insights into the company's leverage, financial structure, and its ability to sustain operations. Key solvency ratios include the debt-to-equity ratio, like we just talked about, debt ratio, which measures the proportion of a company's assets financed by debt, equity multiplier ratio, which measures the proportion of a company's assets financed by shareholders' equity, and times interest earned, that's one that I'm sure you've seen a whole bunch, which assesses how easily a company can cover its interest payments. These ratios collectively provide a picture of a company's long-term financial health and risk profile. Now again, solvency ratio, different than the profitability or liquidity ratio. It's all about long-term, how much of our assets are financed by equity compared to debt, how much debt do we have compared to equity, things that will help the company know how they're doing long-term. Now let's go to the next question. All right, here we are at question 4. Something we always like to point out, which we haven't really had the chance to do in this video, but I wanted to show it still. It's always good to look at the last part of the question because that gives you context for what you're trying to do with the rest of the question. Now, again, this is a very short question, so you don't necessarily need to do it, but it is a good practice to be in, especially for big, long text questions. Under which category of financial ratios or metrics does EPS fall? Okay, so we're talking about financial ratios or metrics. We've talked about ratios so far. What are metrics? Earnings per share, EPS, is a key financial metric used to assess a company's profitability on a per share basis. So again, it's a metric that kind of gives us a hint, kind of gives us basically the answer. We've talked about profitability, we've talked about liquidity, we've talked about solvency. We haven't really talked about performance metrics, so that's probably the right answer. So let's go ahead and look at the answer to learn what performance metrics are. All right, here's the answer. Again, D, we knew that it was performance metric. Let's talk about earnings per share, and then let's talk about performance metrics in general. Earnings per share, or EPS, and we've talked about this a little bit in previous videos, is classified as a performance metric rather than a traditional financial ratio. It measures a company's profitability on a per share basis, indicating how much profit is attributable to each outstanding share of common stock. This metric is important for investors as it helps them understand the portion of a company's profit that they are entitled to as shareholders. Now, that is a key important thing that I wanted to point out with performance metrics, and we're going to talk about it in the next paragraph too. This is mainly about investors. Let's go ahead and read about what performance metrics are, because they can be a little bit confusing as far as what's the difference between a performance metric and maybe like a profitability ratio. That was something that I noticed a lot when I was studying, is I kept getting profitability ratios and performance metrics kind of mixed up. They're similar, but they have a little bit of a different purpose. Performance metrics in general provide insights into a company's operational efficiency, profitability, and overall performance. Now again, that kind of sounds similar to profitability ratio a little bit. They include measures like EPS, EBITDA, price to earnings or the PE ratio, dividend payout, and asset turnover, which help investors and analysts assess how effectively a company is using its resources to generate earnings and create value for shareholders. So that's the big difference there. The key difference, that if you're ever confused whether something's profitability or performance metric or whatever the case may be, if you're thinking about the analysis and the main focus that you're trying to look at is from the investor or the shareholder side of things, how is this company going to be good for those people? A lot of times that's the performance metric. Whereas if it's the company itself trying to figure out how profitable are we, how well did we do in this period, etc., that is something that's more likely going to be a profitability ratio. So performance metrics, a lot of times the main thing that you want to think about is how is this going to be, or how is this going to help investors and shareholders. While profitability ratios focus on margins and returns, and the liquidity and solvency ratios assess financial health, performance metrics give a broader view of how well a company is performing in the market and managing its operations. So it's a lot about how are they performing with their operations, how are they looking to shareholders, things like that. So those are performance metrics. Again, we've talked about profitability, we've talked about liquidity, we've talked about solvency, and we've talked about some performance metrics. These are the general categories that we're going to dive into more in depth in the next videos. But let's go ahead and go do one more question to kind of help that solidify a little bit more. All right, here we are at question 5. Again, it's a good practice, a good habit to be in. Which financial statement ratio would be most appropriate for this type of analysis? Okay, so with that information, let's read the rest. A company has made significant investments in new equipment and property over the past year, and management is interested in evaluating whether these investments have translated to increased sales. Okay, so they're trying to evaluate whether their investments have increased sales, and their investments are into equipment and property. So would this be return on assets, asset turnover ratio, current ratio, return on equity? Current ratio, probably not, because that's mainly focusing on liquidity, like short term, whereas this is trying to focus on, did our equipment help us make more money? Return on equity, again, it doesn't really talk about equity here. So is it going to be the return on assets or the asset turnover ratio? If you know the difference between the two, that's fantastic. You know the answer. If not, that's okay. We're going to look at the answer together. All right, here we are at the answer. The answer is B, asset turnover ratio. So between A and B, it's actually asset turnover ratio. We're going to talk about that, but then we're going to, again, kind of hit all these different ratios and the performance metrics in general. So again, you have a basic, broad understanding of these different ratio categories and the metrics as you go into the next videos and the next topics in the blueprint, where we're going to dive into calculating these and getting much more deep into them. So let's read this explanation. The asset turnover ratio measures how efficiently a company uses its assets to generate revenue, not net income. Now that is the difference here. Return on assets is net income divided by average total assets, whereas asset turnover ratio is specifically the revenue divided by average total assets. So that's why it makes a little bit more sense to look at this one. I guess you could kind of look at the return on assets ratio, but for this one, we were trying to focus on, did this improve sales? Or did this basically improve revenue specifically, not necessarily the net income that takes into account expenses and things like that. We just wanted to look at revenue. It is calculated by dividing total revenue, like I said, by average total assets. This ratio provides insights into whether the company's investments in assets, such as equipment and property, are effectively contributing to increased sales. A higher asset turnover ratio indicates that the company is using its assets more efficiently to produce revenue. When selecting the appropriate financial statement ratio for a specific analysis, and that's kind of what I've been trying to get at this whole video, it's important to identify the category of ratio that matches the analysis focus. Each category of ratio serves a different purpose. This is the main idea behind this video that I wanted to do, is showing you these different types of ratio or these different classifications so that you can kind of have a general idea of what's the goal for each different kind of ratio. And then in the next videos, we're going to break it down more. So the profitability ratios, such as the return on assets and return on equity, these assess a company's ability to generate profit relative to its revenue, assets, or equity. It's focused on mainly on profit. Liquidity ratios, like the current ratio, evaluate a company's ability to meet its short-term obligations, indicating financial health in the near term. Liquidity ratio, I think, is easy to remember because, again, short term, you're trying to see what money you have to cover these things and how quickly you're getting money, how quickly you're paying money, things like that. Solvency ratios focus on a company's ability to meet its long-term obligations, assessing financial stability and leverage over the long term. And then finally, performance metrics ratios, or just performance metrics. These are different, and they're not necessarily like profitability ratios. They might be a little bit confusing. Sometimes I found that myself, that I was thinking some of the profitability ratios were performance metrics and vice versa. They measure how effectively a company uses its resources, such as assets, to generate revenue and profits. That's the thing that kind of got me confused, was like, seems very similar to a profitability ratio, but the main thing that you want to pay attention to is these kinds of ratios, or these metrics, are there for the benefit of investors and creditors. These are there mainly to show people, hey, this is how well the company is managing its resources. Hey, this is how much money you're going to get if you're a shareholder. It's much more from that side of things. Whereas profitability ratio, again, is mainly just about how much money is the company making, how well are they using their assets and equity and stuff to generate that money, things like that. So in this scenario, the company wants to assess the efficiency of its asset investments in generating sales, specifically sales, which falls under performance metrics and efficiency ratios. You're going to kind of have to memorize what some of these are, but I wanted to give you a general idea of what typically falls into these categories. The asset turnover ratio is most appropriate here, as it directly measures how well the company is utilizing its assets to produce revenue. Understanding the goal of the analysis helps in choosing the right category and, subsequently, the most relevant financial ratio or metric to use. That's kind of the whole crux of this whole video. I was trying to kind of give you a general idea of the different categories of ratios and the metrics so that you generally know, hey, if I want to analyze this, what would that fall into? Would that be a profitability ratio? Would that be a liquidity ratio? And then from there, again, in the next videos, we're going to dive much more into each of these. But from there, you can kind of understand, well, these are the ratios that fall into that category. So which one of these would make the most sense? So that was the general idea with this. And with that, before we go any further to kind of hit that home again, let's do another part of the Superfast CPA process, which is pillar topics. Now, the idea behind pillar topics is as you're going through the material, you will notice the things that keep popping up. You will notice the ratios that they keep trying to teach you. You will notice, hey, all of these ratios seem to have to do with profitability. Oh, it's because they're all profitability ratios. Things like that. These are the things that you notice, so you summarize them as pillar topics so that you have them for later and you have them in your own words. Let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. So let's again talk about each of these different categories for ratios, and we're going to dive deep into each of these in the next videos, the next 4 or 5 videos. We're going to talk about each of them in more depth. So I wanted to give a general idea for each of these here. Profitability ratios, these measure a company's ability to generate profit relative to its revenue, assets, or equity. These ratios help assess the efficiency of operations and the company's overall financial success. So again, overall profitability, overall success. These would be things like profit margin, return on assets, return on equity. Then there's liquidity ratios. These evaluate a company's capacity to meet its short-term obligations using its current assets. They provide insight into the company's short-term financial health and ability to handle immediate financial demands. This would be things like the current ratio, the quick ratio, days in inventory, things like that. Again, short-term stuff. Then there's the solvency ratios. These assess a company's long-term financial stability by examining its ability to meet long-term obligations. These ratios indicate the level of financial risk and the company's leverage in its capital structure. That would be like debt to equity, debt ratio, times interest earned. And then finally, there's the performance metrics. These are a little bit different than the ratios, although they are technically ratios themselves, but they're used for a slightly different purpose. These measure how effectively a company uses its resources such as assets to generate revenue and profits. They help identify the operational efficiency and productivity of the company in utilizing its resources for investors and creditors. So this would be things like asset turnover, EPS, earnings per share, or EBITDA. That would be earnings before interest, taxes, depreciation, amortization. So again, performance metrics are much more from the standpoint of investors and creditors. Of course, all of these ratios can be helpful to them, but performance metrics are mainly for that purpose. And these are the general categories. These are the general things that we're going to dive deep into. We're going to learn a lot about all the different kinds of profitability ratios, all the different kinds of liquidity ratios, and so on in the next videos. So this is a general overview because this will help you know, okay, what am I trying to analyze? This is probably something to do with profit or how well the company is doing. So it's probably a profitability ratio, and then you can kind of think about the different profitability ratios, and that will help you in the long term as well. So with that, that is the end of the video. Those were the pillar topics. And before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it is only 1 hour, and we will teach you the key ingredients to passing the CPA exam so that you don't waste months or even years of your time. Again, focusing on the questions. That is the main idea. So go check that out. And if you like it, and if you like these other videos that we're making, if you become a pro member, you will get access to the full 10 question videos that we typically post in the members forum. So again, if you like this, you can get more of it by becoming a pro member and getting access to all of our videos and also all of our strategies and resources. If you like the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.